Your phone is in your bag. Jack wants to know how you're not freaking out. You don't know what he's talking about. By the time this decade ends, your account will have more than $200,000 more than his. You don't know that yet. Neither does he. This is how it happens.
How are you not freaking out right now?
He's trying to sound casual. He's failing.
Freaking out about what?
Your phone has been in your bag since you walked in this morning. The market could be doing anything. It is. Since Monday, Jack's account is down $42,000. So is yours, almost to the dollar. Same company, same 401k, same fund, same brutal week. Right now you are identical. Same starting salary, same contribution rate, same index fund, same devastation on paper. Not for long. Jack did everything right on the way up. He started contributing in his early 30s. Let the 401k auto-escalate. Never tried to pick stocks. One index fund, 15 years, never touched it. For a long time, the account was a quiet helper in the background. A few $100s a month going in, a number on a statement he glanced at every quarter. Then, the math changed shape. The same 1% move that used to be $100 was now $9,000. A normal Wednesday could shift the account by more than his mortgage payment. A bad Wednesday could erase a year of contributions in an afternoon. And without ever quite deciding to, Jack started checking. First a few times a day, then dozens. By the bad weeks, he was awake at 2 a.m, refreshing an app for a market that had closed 3 hours earlier. He knew there was nothing to do. He refreshed anyway. The app had developed the exact pull a slot machine has. Not because Jack is weak, but because the numbers had finally gotten big enough to feel like something. And here is what Jack did with that feeling. He adjusted. A little more cash, a little less stock. After one ugly week, a lot less stock. He told himself he was being prudent. 6 months later, the market was higher than where he sold. He bought back in at a worse price than he left. He didn't panic sell. He adjusted. And the adjustments, compounded over a decade, are where the $200,000 goes. You learned the same lesson Jack is paying for, except you learned it earlier, from watching your father lose money in 2008. Not because he was careless, because he was watching, and watching, at that size, cost him. So 3 years ago, on a quiet Sunday afternoon, you wrote 4 sentences on a Post-it and stuck it to your fridge. They are not impressive. They are not a strategy. There is no stay calm on that note, no trust the process. You already knew those were character traits, and character traits do not survive a screen showing you down $40,000 before lunch. There is just one idea, structural, not emotional. Don't be standing in front of the slot machine on the day your nervous system loses its mind, and a mechanism that fires automatically without asking your permission. That is why your phone is in your bag today. Not because you're braver than Jack, not smarter. You don't enjoy the red weeks any more than he does. You just automated yourself out of the room where the damage gets done. I went looking for why 4 sentences on a Post-it can be worth $200,000. The research points straight at one thing. Morningstar tracks 2 numbers for every major fund. The first is what the fund itself earned. The second is what the average dollar actually earned, once you account for when investors moved in and when they moved out. The 2 numbers are never the same. Over the past decade, the average fund returned about 8.2% a year. The average dollar in those same funds earned about 7.0. 1.25 points every year, handed back. Not to a fee, not to a tax, just to the cost of being in the room when the market moved and reacting. On Jack's portfolio, that gap runs to roughly $200,000 over a decade. It doesn't appear on any statement. It only shows up when you put the fund's return next to his account's return and trace the difference to the dates he sold and the dates he crawled back in. On your account, it won't show up. because the gap only exists when someone acts. And your system is specifically built not to act. Now, why does the gap exist in the first place? When Jack sees $42,000 disappear, his nervous system does not file it as a 10% correction. It files it as an $84,000 emergency. Yours does the same thing. The same program runs in every brain. Losing $1 feels about twice as bad as gaining $1 feels good. That asymmetry has been documented for almost 50 years. Same architecture, every income level, every portfolio. The difference is what scale does to it. On a $50,000 account, a 10% drop is $5,000. It stings. You can almost look away. On $850,000, the same percentage is $85,000. The equity in a house, a year of tuition, the kind of number the brain cannot file as a market event. It files it as loss. The same man who held through every dip on the way up, who barely flinched at $5,000, cannot hold through that dip at $85,000. Not because he became weaker, because the stakes finally crossed the threshold where his nervous system overrides everything else. The only thing that reliably beats that asymmetry at scale is not being in the room when it fires. That is all your 4 sentences do. They are not making you smarter. They are keeping you somewhere else during the 30 days when most of Jack's damage gets done. Jack's account is reacting to the market and to his reading of the market. 2 inputs, both jumpy. Yours is reacting to the market only. 1 input. That is the whole game. Not income, not intelligence, not knowing more about markets. Just how much of the noise actually reaches you during the moments when noise costs money. How are you not freaking out right now? Jack is going to refresh that app 11 more times before he goes to bed tonight. The market is closed. There is nothing he can do. He knows. He refreshes anyway, because the brain that built him doesn't care that the market is closed. You're going to leave work, make dinner, and not find out what the market did today until your birthday, when the calendar tells you to look. Same firm, same job, same fund, same year. And by the time the decade ends, your account will have more than $200,000 more than his. And neither of you will be able to point to a single decision that explains it. Because you didn't make that decision this week. You made it 3 years ago, on a quiet afternoon, when you wrote 4 sentences on a Post-it and stuck it to your fridge. The market doesn't punish the panicked. It just pays them less. Quietly, every year, until the decade is gone. The system behind those 4 sentences, the mechanics that make it hold when every instinct says to act. I've put it all in one place. Start there. Meanwhile, I'll keep reading the fine print.